usually when the tax consequences of an IUL come into play, it's years down the road. So it's not like you just had this conversation last week and now all of a sudden it's taxable. Hey everybody, welcome back in. Matt McKay, Safeguard Insurance, here, excited about episode 5 of our IUL series that we have been doing on, you guessed it, IULs. And we've talked about several different subjects. We talked about the basics, we talked about pros and cons, we talked about IUL for dummies, and our last episode was about IUL for kids. This episode, we're going to talk about how IULs are taxed. And so this can be multi-layered. There's no way that we can cover this in a succinct video. So I'm going to do my best to cover what we can and make sure that you have the basic ideas. But obviously you want to consult both tax professionals as well as make sure you have an agent or advisor that knows what the heck they're doing. Obviously, you can definitely go wrong in some things if all of a sudden something you assume is completely non-taxable is all of a sudden taxable, and that's why you want to make sure that you take care of it and do the right thing and think it out before you just do stuff, especially on decades old advice sometimes where someone told you, hey, you can stop paying on this and now it's going to have a gold mine in there or whatever. That's probably an old concept that you might want to revisit, for example. Or this won't be taxed if you do this certain thing. Well, you might not remember that from 20 years ago exactly how it's going to work out, or 10 or 15 or whatever. Because usually when the tax consequences of an IUL come into play, it's years down the road. So it's not like you just had this conversation last week and now all of a sudden it's taxable. So let's get into it a little bit. There are different concerns about taxes for different people. Some people, taxes are not that big a deal. You don't make that much money, or you don't have a super high income. You have a flat tax that you worry about, whatever. Not that massive, but it can certainly make a difference if you plan things out. However, people that are really affected by taxes, people that have a higher income especially, are the ones that are more affected by this. People that have the ability, for example, to put in lump sums of money to fund a life insurance and just drop it in and be done with it. Well, that creates some tax consequences if you're not careful. If you have, for example, say that you've overfunded life insurance, that's another time that you could come into some tax scenarios, things like that. If you've gone over the legal limits that make your life insurance now a modified endowment contract, that's when you can deal with some tax consequences within the IUL. But for the most part, Americans especially have, a lot of people have 401ks or they have IRAs that they've invested in. And they're awesome investments because you put the money in before you pay taxes on it, and then when you pull it out in retirement, hopefully your tax bracket is much less than when you were working. So you save all that money, you build up all that kind of cash, and then you pull it out and you pay a few taxes on it, right? Well, what if you've got all your money in your 401k or your IRAs or whatever, and the only thing that you have that's not really affecting that is your Social Security, and then everything else is 401k or IRA or whatever? Well, that could create a headache, because let's say that you do need a chunk of money in your retirement. You need an $80,000 truck. You don't have the cash and you don't want to put it on your debt. Well, to get an $80,000 truck, you're probably going to need to pull out well into six figures of your money to be able to actually have $80,000 to pay for that truck. Well, let's say that you have it in your life insurance and you do it properly and everything. You take out a small loan or you partial surrender it off depending on the exact timing and everything, and it's tax free, no taxes. That could be quite an advantage. Maybe you have high enough income at some point that you aren't able to do anything in a Roth IRA, which is income limit. So if you make us a couple over $200,000, and it's not exactly 2,000, but I'm just giving you numbers that definitely are over. If you make $200,000 a year, you're out. You can't get a Roth, right? A Roth is you pay taxes now, then you don't pay taxes when you pull it out. And that would solve the problem of I need a chunk of money, or I want to draw income right now, or whatever, without taxes. Well, if you only have your 401k and IRA money, you're going to pay taxes when you pull out of it. If you need to buy a house, whatever. So having these different options in your retirement, we talk about diversifying, and a lot of people think, let me diversify my assets. I don't want to be all in Tesla stock, and I don't want to have just mutual funds, and I don't want to just have life insurance, or I don't want to just have fixed annuities, and I don't want to just be in the market, whatever. That's great, but what about your taxes? What about diversifying your tax burden in retirement? You have different buckets that are going to be taxed differently. If you have a brokerage account that's non-qualified, or you have a CD that you took cash and dropped in because you had money in the bank and didn't know what to do with. By the way, you can do better than a CD. Anyway, those, for example, would be taxed on the gains, and that can be complicated and frustrating. Obviously, 401k, I hit that several times. Completely taxable. Whatever amount you pull out now counts as your income, and certainly could have some tax consequences when doing that. But life insurance cash value does not have taxes. It doesn't have taxes on what? It generally doesn't have taxes. It doesn't have the 10% penalty under 59.5. So if you pull money out of any kind of tied up investment, an IRA or whatever, Roth or not, whatever, you're going to pay 10% penalty. Annuity, if it's in an annuity, same thing. If it's tied up in an investment vehicle and you pull it out before 59.5, you're going to pay taxes at 10% tax penalty for pulling it out early. So you have different options under and over 59.5 within the cash value of life insurance that can help you save tons on taxes. We call it the tax triangle. There are 3 different ways that you can be taxed. You have your tax advantaged, tax free, and taxable. Each one of them have their different pros and cons, and they each have their place. There's nothing wrong with any of them. But if you have it all in one bucket, then you don't have the options to do anything but that one bucket. If taxes are super high in the future, which guess what? They're at historically low levels right now. Where do you think they're going to go? If I said, do you think taxes are going to be higher or lower? Most people are going to say they're going to be higher. I'd be shocked if they go lower because the government just dug further holes. It's not a political statement, just taxes are probably going to go higher regardless of who's in office, red or blue or whatever other party forms. Guess what? Taxes are going to go higher. So if that happens and everything's taxable and you plan on having cheap taxable money in retirement, well, now you've gotten used to low tax brackets, and all of a sudden you now possibly could pay more even though you are making less money in retirement. So you make less and pay more in the taxes. That's not ideal, I would say. I think that's fair to say. So consider the option of some kind of life insurance with cash value that you can overfund, especially if you have money sitting in a bank account, or you go through your $20,000 or so that you can put in your retirement. You've put money in a Roth or in a traditional IRA to the limits that you can, and you've got another $10,000 to $100,000 extra that you want to put in somewhere and do something with it, and that's every year or that's a single dump or whatever. Well, consider an IUL as that vehicle, or some kind of interest sensitive whole life is another option. Whatever, something that's going to build some cash value and grow that thing, and then you've got another vehicle that you can pull out steady income in retirement, tax free or tax advantaged. And so I really think that it's something that brings a lot of value to a lot of people, and a lot of people don't do it because it takes a commitment, or it's something that they don't really get the idea. But it really can set you up well, especially if you have some extra money. So diversify your taxes along with diversifying your assets. Thanks, guys. Looking forward to our last and final episode, episode 6, talking to the ideal person that can get tax-free retirement savings for high income earners. See you all next episode.